Welcome to the Deep Dive. I'm Kian.
And I'm Nika.
And we're diving into some fascinating market trends today. You know, our listeners plugged into the markets and wants to make sense of all this recent buzz about AI activity in those tech stocks. Especially all that activity we saw around DeepSeek AI that just came out of China. Just a complete shockwave.
It really shook things up. Yeah, DeepSeek's technology it seems to be incredibly efficient, and I think that's what really spooked investors.
Yeah.
Triggered that sell-off in tech stocks. We saw Nvidia getting hit especially hard.
Yeah, Nvidia's 17% drop during that sell-off. That was definitely hard to ignore. So is DeepSeek really that much of a threat?
You know, I don't think it's necessarily about DeepSeek being a direct threat to Nvidia. I think it's more about investors starting to question whether Nvidia can actually maintain its, leading position in providing those GPUs for AI.
Right.
So when you have a new player coming in showing that much potential, it introduces uncertainty, and that uncertainty often leads to a knee-jerk reaction in the market.
Yeah, makes sense. Uncertainty about Nvidia's future dominance. But then we saw a pretty interesting split in how investors actually responded to the dip.
Yeah, we saw retail investors basically seeing this as a huge buying opportunity.
Yeah.
Vander Research actually reported that retail traders bought a record amount of Nvidia shares during that sell-off.
Wow.
It seems like they're betting on the long-term potential of AI, and they see this as a temporary blip.
Interesting. So they're thinking long-term, but that's not how the hedge funds played it at all, right?
No, not at all. Hedge funds largely stayed on the sidelines. And JP Morgan analysts have even suggested that some funds might be, reevaluating that whole idea that the U.S. will stay ahead in the AI race.
So retail investors jumping in thinking long-term, hedge funds, maybe having some second thoughts about who's going to lead in this AI race. That makes the analysts' take on all this even more fascinating, because Wall Street analysts are actually still very bullish on Nvidia, despite the sell-off.
Yeah, they are. The consensus seems to be that this is a temporary setback. Toshiya Hari, an analyst at Goldman Sachs, he believes that the demand for GPUs will continue to grow. He said, and I quote, "Scaling AI will still drive demand for GPUs." So the idea is that AI development and adoption will only accelerate, which means more demand for those products that Nvidia is making.
Okay, that's good news for anyone holding Nvidia stock.
Yeah.
But zooming out a little bit, we have to ask, what does this DeepSeek situation say about big tech's commitment to AI? I mean, are companies like Meta and Microsoft still all in?
Oh, absolutely.
Okay.
They're all in. In recent earnings calls, both companies have made it very clear that they are not scaling back their AI investments. In fact, they're doubling down.
Okay, so we're talking serious money here. Meta reaffirmed their capital expenditure guidance for 2025 at a massive $60 to $65 billion, with a lot of that going to GPUs and AI infrastructure.
Yeah, and Microsoft has committed even more, a whopping $80 billion for AI-enabled data centers. And they're predicting exponential growth in demand for AI, so this investment makes a lot of sense for them strategically.
So they're looking way beyond this little blip with DeepSeek. They're saying, hey, we're in the AI game for the long haul.
Precisely. This whole scramble to achieve artificial general intelligence, or AGI, it's driving a lot of this investment. These companies want to be the leaders.
Yeah, it makes you wonder, are they reacting in part to this new competition? We had this initial scare with the sell-off, and now, boom, huge AI investments. Is it possible that DeepSeek is actually accelerating this whole race?
I think that's definitely a possibility. Competition often breeds innovation. Now let's shift gears a little bit to a different kind of indicator, something that might give us a clue about the overall market performance for 2025. We're talking about the January Barometer.
The January Barometer. I always find this one really intriguing. So how did January shape up?
Well, January was positive, which historically is a good sign for the rest of the year. We saw the S&P 500 up 3.2%, the Russell 2000 gained 3.5%, and the NASDAQ composite rose 1.9%.
Those are solid gains. I mean, does that mean we can just assume smooth sailing for the rest of the year?
Well, not necessarily. There is historical data that does support this positive outlook. When January is positive, the full year tends to follow suit about 84% of the time.
84%, that is pretty compelling.
Yeah.
But you're hesitant, so there must be a catch.
Well, analyst Jeffrey Hirsch, he's predicting growth in 2025 somewhere between 8% and 12%, but he's also warning about volatility. He thinks we might see some choppiness, especially in the first and third quarters.
Okay.
And Steven Suppmeyer from Bank of America, he points out that for this January barometer to actually hold true, the S&P 500 needs to stay above 5,882. That's a key number to watch.
5,882.
Got it.
Got it. So cautious optimism, some potential bumps in the road, but overall some positive signs based on January's performance. Of course, we can't forget about the Federal Reserve. They have a big impact on market sentiment, and this week they decided to hold steady, keeping interest rates unchanged for now.
Yeah, the Fed's actions, particularly when it comes to interest rates, are always crucial.
Yeah.
And while they held steady this time, the market seems to be expecting a rate cut in June. According to Fed Funds futures, there's a 62% chance of 2 cuts before the end of the year.
So the market's saying rate cuts are coming. Are the analysts in agreement?
Not entirely. While the market is pricing in those cuts, analysts have different opinions. Goldman Sachs is predicting 2 cuts in June and December, but Deutsche Bank and Bank of America, they're not so sure. They cite persistent inflation and a strong labor market as reasons for the Fed to maybe stay a bit more cautious.
Okay, so a little bit of a split there.
Yeah.
What's the inflation situation looking like right now?
Well, inflation is definitely a key concern. It's currently sitting at 2.2%, which is above the Fed's 2% target. So this is one of the reasons that some analysts are hesitant to predict those rate cuts. The Fed is in a tricky position trying to balance economic growth with price stability.
Yeah, that sounds like a lot of uncertainty. But we do have one outlier prediction. Morgan Stanley actually thinks a rate cut could come as early as March.
Yeah, they do, but that's a less popular view at the moment. We'll have to wait and see how things play out.
All right, so we've covered a lot of ground in this first part of our deep dive. AI making waves, the January Barometer giving us a cautiously optimistic outlook, and the Federal Reserve holding steady for now, but with some potential rate cuts looming on the horizon.
A lot to unpack.
A lot to unpack indeed.
So we just spent some time unpacking the AI landscape and looking at some of those broader market signals for 2025. But it's also really important to remember that, different sectors of the market each have their own unique stories going on.
Yeah, absolutely. Different parts of the market can be affected by those larger trends in different ways. So where should we zoom in next?
Well, let's take a closer look at the semiconductor industry. Specifically, the potential effects of the Biden administration's restrictions on selling those chips to China.
Oh, yeah. That's been a hot topic in the news lately. A lot of back and forth about whether those restrictions are the right move. Can you remind us what they're about?
Yeah, so basically the Biden administration is considering further restrictions on the sale of advanced computer chips to China, particularly the types that are used for, AI development. The goal is sort of twofold. They want to maintain the U.S.'s lead in that technology and also address some of those national security concerns.
So it's a move in this, global tech power struggle. But I imagine that this has some pretty serious implications for the market.
Oh, absolutely. There are concerns that these restrictions could really hurt American companies that do business with China, including Nvidia, because they're a major supplier of those high-end chips.
It's kind of ironic, right? On the one hand, we're worried about China's AI progress with DeepSeek, and on the other hand, we're potentially limiting a major U.S. player in the AI chip space.
Yeah, it's a very complex situation with no easy answers. The market sentiment seems to be pretty mixed. Some analysts actually support the restrictions. They argue that they're necessary to protect U.S. interests, even if it means, some short-term pain for companies like Nvidia.
Okay.
Others, though, are worried that it could actually backfire.
Backfire how?
Well, if China can't buy those advanced chips from the U.S., they might decide to just pour more resources into developing their own domestic chip industry.
Makes sense.
And if they succeed at that, that could actually weaken the U.S.'s long-term position in that semiconductor market.
So it's all about weighing those potential risks and benefits. It's a classic dilemma in the world of technology and global competition.
Exactly. And it really highlights the need to think strategically, not just about today's market, but about those long-term consequences of these types of actions.
It's all about making informed decisions, understanding those ripple effects. And I think this kind of brings us to another crucial aspect of the AI conversation, the whole debate about responsible development. It's not just about making AI more powerful, but also about how we manage those advancements.
Right. As AI technology continues to progress, we really have to consider those potential risks and the ethical implications.
Yeah, it's like we're seeing this play out in real time right now with DeepSeek. Their technology is incredibly efficient, which is impressive on one hand, but it also raises questions about, what happens when AI systems become even more powerful than this.
Yeah, definitely. There are concerns about, potential bias in algorithms, the spread of misinformation, and even, the potential for autonomous weapons systems.
Wow, those are some serious issues that can't be ignored.
No, they can't. And there's a growing movement advocating for this idea of responsible AI development.
Yeah.
The goal is to try to establish some ethical guidelines and frameworks to make sure that AI is used for good and not for harm.
That makes me think about how Microsoft and Meta were framing their AI investments. They emphasize the positive potential, of course, but it also raises the question, how do they and other tech giants plan to actually address these ethical concerns as they develop increasingly powerful AI systems?
That's a critical question, both for investors and for society as a whole.
Right? Because it's not just about the technology itself. It's about how it's actually being used, who has control over it, and what kind of impact it's going to have on the world.
Now let's shift gears again to another area that's really generating a lot of buzz. We're talking about the rise of the metaverse.
The metaverse.
Yeah.
It's a term we hear everywhere these days. But I'm not sure everyone really understands what it means. What is it exactly, and why should our listener care?
So in simple terms, the metaverse is basically a collection of immersive digital spaces where people can interact with each other, have all sorts of experiences, and even conduct business. Think virtual reality, augmented reality, and those other technologies that are kind of blurring the lines between the digital and the physical world.
So it's kind of like stepping into a video game, but with real-world implications.
Yeah, that's actually a pretty good analogy. While it's still very early days for the metaverse, the potential impact on a variety of industries is massive.
Yeah, we're already seeing companies kind of dipping their toes in and using the metaverse in some pretty creative ways.
Definitely. In the gaming world, you have companies like Roblox and Fortnite. They've created these massive virtual worlds where players can socialize, create content, and even earn real money.
Okay, what about outside of gaming?
Well, we're seeing, virtual concerts and events popping up in the entertainment industry. They offer fans a totally new way to experience live performances. And in education, virtual reality is being used to create these immersive learning environments that can transport students to different times and places.
Yeah, that sounds like the possibilities are kind of endless.
Yeah.
But I imagine there are some challenges involved in actually making the metaverse truly mainstream.
Oh, for sure. Technically, we need more powerful and affordable VR and AR devices.
Right.
There are also legitimate concerns about privacy, security, and the potential for, harmful content in these virtual spaces.
So navigating those challenges is really going to be key to the metaverse's success.
Yeah, it's a new frontier full of potential, but also risks and uncertainties. And for someone who's trying to stay ahead of the curve, like you, our listener, it's crucial to understand both the opportunities and the challenges this technology presents.
We've covered a lot of ground in this deep dive. The impact of AI on the tech sector, that potential disruption from the U.S. chip restrictions, the rise of the metaverse. And I think now it's time to shift our focus to something that's often overlooked in this market analysis, but it's actually a major driving force. We're talking about the job market.
Yeah, the job market's absolutely crucial for economic growth. It affects consumer spending, inflation, even the Fed's decisions on interest rates.
Right. A strong job market usually means a healthy economy. So what's the current state of the U.S. job market looking like?
Well, it's kind of a mixed bag. On the positive side, unemployment is relatively low, around 3.5%. So that's a good sign of a robust labor market. People are working, and that's good for the overall economy.
That is encouraging. But you said it's mixed, so there must be some downsides as well.
Yeah, there are a couple of areas of concern. First, wage growth has been lagging behind inflation.
Okay.
So this means that even though people are working, their paychecks aren't keeping up with the rising cost of those goods and services.
So they're feeling the pinch. And if people aren't feeling financially secure, they're less likely to spend, which could ultimately slow down the economy.
Exactly. The second concern is the potential for job displacement because of automation.
Right.
As AI and robotics become even more sophisticated, there's that risk that certain jobs could be automated, which would leave people out of work.
Yeah, it's a valid concern. I mean, this has been a recurring theme throughout history. New technologies come along, they disrupt the job market. But can't we adapt? Can't we create new opportunities?
I think we can, but it requires a really proactive approach. Policymakers and businesses, they need to invest in education and retraining programs to help workers adapt to those changing demands of the job market.
So it's all about equipping people with the skills they need to thrive in a future where AI and automation are even more prevalent.
Exactly. And, companies can play a role in this too. They can focus on creating those new job opportunities that leverage both technology and those uniquely human skills. There will always be a need for things like creativity, critical thinking, and emotional intelligence, things that machines just can't replicate.
So it's not about humans versus machines. It's about finding ways for humans and technology to work together to create a more efficient and productive economy, while also making sure that people have those fulfilling and well-paying jobs.
Precisely. It's about finding that balance. And that's something really important to keep in mind as you, our listener, navigate your own career and investment decisions.
Yeah, that's a great point to end on. We've explored a lot of different angles in this deep dive. The impact of AI on the tech sector, the potential disruption of those U.S. chip restrictions, the rise of the metaverse, and that ever-present importance of the job market. It's a complex and constantly changing landscape. But hopefully we've given you some valuable insights to help you make sense of it all.
Remember, the market is always evolving, so staying informed and adapting to new information is key.
Thanks for joining us on this deep dive.